Hello and welcome. I'm Richard and this is the Art of Arbitrage. Today on the channel we're looking at the UK housing sector and in particular the proposed £7.5 billion all-share merger between house builders Redrow and Barratt. I hope you find the content useful, and if you have any questions about the content or suggestions about what would make the videos more valuable to you, please let me know in the comments. So, let's get to it. The UK housing sector is a complete mess. With a growing population and a net migration of 1 million people last year alone, the UK has fewer homes per person than most countries globally. The government believes the country needs to build anywhere from 300,000 to 550,000 new homes each year. However, due to lackluster output, the country has only averaged approximately 200,000 new homes each year over the last decade. It is estimated there is a backlog of 4.3 million homes that have never been built. This shortage has been a considerable factor in driving up house prices over the last 20 years. The average house price is now equal to 9 times the average salary, the ratio that was just 3.5 times earnings over the last century. Another perceived problem with UK house building is the concentration of output in a smaller number of large house builders who, it is alleged, are strangling output in order to keep prices high. There were approximately 12,000 small house builders in the 1980s, who were responsible for 40% of all new houses built. By 2020, the number of small house builders have fallen to just 1,000, who collectively build fewer than 10% of all new homes. The top 10 largest house builders are now responsible for about 50% of all new homes. In the midst of this chaos, Barratt Developments, the largest UK house builder with a market value of £5 billion, is attempting to take over Redrow, the 7th largest house builder, with a market value of £2.5 billion. Redrow was established by Steve Morgan in Wales in 1974 with £5,000 and a focus on civil engineering. It was in 1982 that the company got a start in house building and has since grown to be a national player with 12 divisions across the UK. The company typically has 100 live developments at any time, generates annual revenue of £1.85 billion, with net income of £200 million. Barratt Developments was founded in 1958 and has grown to be the largest UK house builder. Rather ironically, the company was founded by Lloyd Barratt, an accountant who was frustrated at the high purchase prices of houses for first-time buyers. He decided to purchase 5 acres of land on which to have starter homes built at fair prices. The company now builds more than 17,000 houses per year. On the 7th of February 2024, Barratt made an offer to buy Redrow in an all-share deal at a 27% premium to the prior day's share price. The deal was agreed by the boards of directors at both companies and has since been approved by more than 99% of all shareholders. The last remaining hurdle is regulatory approval for the merger. However, this could be a sticking point. In February 2024, Barratt and Redrow were among 8 UK house builders targeted by the Competition and Markets Authority in an investigation into suspected breaches of competition law. The Competition and Markets Authority said it had evidence that firms shared commercially sensitive information with competitors, influencing the build-out of sites and the prices of new homes. So, the successful completion of this deal isn't a home run just yet. Anyway, let's take a look at the numbers. Barratt is offering 1.44 of its shares for each share of Redrow. In order for an arbitrager to take a position in this deal, they will need to take a long position in Redrow and short 1.44 Barratt shares for each Redrow share purchased in order to secure a risk-free exchange. In addition to this exchange, and assuming a close date in January 2025, the investor will receive 50p in dividends from their long position in Redrow, but will have to pay 33.8p on the Barratt shares that have been borrowed and shorted. At today's prices, each Redrow share is worth £7.71, and each Barratt share £5.43. This means Redrow shareholders will receive £7.82 in Barratt shares for every £7.71 of Redrow shares tendered. So, when we plug all of this data into our spreadsheet, an exchange ratio of 1.44 shares, an expected duration of 169 days, a long dividend of 50 pence, short dividends of 33.8 pence, an estimated downside price of £5.81 on Redrow, and an estimated upside price of £5.21 on Barratt. Should the deal fail to close, then we can calculate our estimated returns. An investor taking a position in this deal today can expect an unleveraged return of 2.82%, which translates to an annual rate of return of 6.08%. However, even with the shareholder approval, the remaining risk from the Competition Authority results in an expected risk-adjusted return of negative 9.01%. Should the deal fail to close, an investor would face an expected loss of 24.59% in closing out the trade. So, to answer our original question, can you profit from the UK housing market? Probably yes, but not particularly well from this deal. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.